Well, good morning, everyone. I'm delighted you can join us for our first panel of the day entitled, What's the Exit Strategy? How will the ECB step back from the covered bond market? Well, it's a very interesting and timely topic, of course, especially after last week's ECB meeting, during which it was announced it would slow its purchase of government bonds. Christine Lagarde preferred the word recalibration to tapering, but the message was clear enough. The velocity would be falling. I thought it was a deft bit of central banking. A tantrum was avoided, but we know the direction of travel. Now, and while covered bonds might perhaps not be front of mind for Christine Lagarde herself, the asset class is very much part of the central bank's armory. It's going to be fascinating how the ECB views the product and how it might reduce its influence in the market as the economy recovers and banks remain healthy and indeed get stronger. Now, to discuss these key points, I'm very pleased to say that we have three fantastic panelists for you today. Why don't we quickly meet them? And I'd like to start with Casper.
Hi, my name is Casper Andersen. I'm a senior director in the S&P Covered Bond team, responsible for the Nordics and the DACH region.
Thank you, Casper. Julien?
Yeah, well, good morning, good afternoon, good evening, depending where you're sitting at the moment. My name is Julien Marchand. I'm heading here at NordLB, the origination and syndicate desk for financial institutions and agencies.
Thank you very much. Matthias.
Yeah, good morning from Frankfurt, everyone. My name is Matthias, and I'm running the DCM and syndicate for FI and SSA at Helleber. Pleasure to be here this morning.
Great, thank you very much. Now, I'd just like to encourage the audience to ask questions. Just as you do at a live event, we also have the ability for you to ask our panelists questions. I think there's a box on the right-hand side of your screens that you can enter your questions into. And then my colleague, Emma, in the background will basically pass those on to us, and I will try and put those to our panelists before we run out of time today. Please, I really do encourage questions. Great opportunity to ask our great panelists some interesting questions. So let's crack on with the panel. And worth repeating the name of it, actually, which is what is the exit strategy? How will the ECB step back from the covered bond market? Well, in my mind, there are at least three ways that the ECB could reduce its influence on the covered bond market. The first two as part of tactical shifts, the last as a more data-dependent unwind of QE. I'd like to, if possible, consider these three, their preconditions and likely effects on the covered bond market in turn. The first one is the shift of the purchase programs away from covered bonds and towards other asset classes, in particular the EU's new bond program. Will this cause a generic widening of covered bonds relative to bonds or swaps? Who wants to take this one? How about Matthias?
Yeah, thanks, Toby, for this question. When you look at the overall data, we have to see that under the asset purchase program overall, the ECB just bought 1 billion from July to August 21, and under the pandemic purchase program, it was also just a little bit more than 1 billion. So what I want to say with this is that in comparison to the other asset classes, the ECB is still buying in very low number on a net basis in covered bond yet. What you have to consider is the reinvesting. And we talk about reinvesting for covered bonds of roughly at the moment 30, a little bit more billion a year. So if the ECB will stop net buying, I would say the effects on secondary spreads is really limited because I assume that the ECB still will be there with some with a lot of reinvesting, talking about 2.5 billion a month. Not sure if the effect on primary is much more is a much greater one. So this could be a reason for some spread widening there if the ECB will not come back in the books anymore. But overall, I want to say stop of net buying, is only a minor effect. We have to analyze really the consequences as a stop of reinvesting, but I think that's a topic for a little bit later today.
Yeah. Julia, how about you?
Yeah, well, I think Matthias is fully right for what he just mentioned. And one point that we shouldn't forget is, of course, the spillover effects that you would have if the focus would be more on agencies or government bonds in the secondary market, because then you have again this relative value aspect, which makes covered bonds even more richer for investors. And this, of course, if more investors are getting back into this segment, that could have, of course, as well a positive effect on spread tightening for this asset class. So fully agree with Matthias. Even though the ECB would reduce their net buyings, I think the effect on the covered market should be limited, to be honest.
And would that include sort of the widening of the covered bond SSA differential in that, from what you're saying?
Well, I think at the beginning you would have this effect, of course, but as I just mentioned, especially this attractive relative value aspect would bring then more investors back into this asset class, which on the other hand would then result in a spread narrowing of the agency space and coverage again. So yes, at the beginning, definitely that would have an effect on this differential, but I think you would see a kind of shifting again in the same directions again.
Yeah, yeah. Now,
so
of course,
one aspect, sorry that I interrupt, but one aspect that we should analyze is the consequences of the huge issuance of the next-gen EU program. Today issued, or is still issuing a 7-year, I think the spread is fixed at the moment at -16, correct me when I'm wrong, please, around -16 for 7 years. That would mean a pickup when you compare to generic 7-year covered bonds of around somewhere 14 basis points if you take German generic spreads. So I'm not sure if this spread pickup for covers in comparison to EU is huge enough to stabilize spreads where we are. We should take something in mind. We're trading on covers, midterm maturity, 5-7 years, around mid-swap flat for core jurisdictions. We don't have any spread differentiation between stronger and a little bit weaker names, only minor spread differentiation between countries. We even see a curve that is relatively flat when you look at the single country curves. So, for example, the 3 to 7 year spread in Germany is at the moment just 2.5 basis points, means that shows me a market that is highly influenced by the former ECB buying we have observed in the past. And if the ECB will step back now, maybe that could have influence on spread, that investor says 15 basis point versus EU AAA is maybe not enough, as you have to consider, especially for bank treasuries, 0% risk weight versus 10% for covered bonds when you fulfill the special requirements.
Yeah.
Maybe if I can step in there as well. I mean, it's true that you see a spread narrowing between jurisdictions and as well within issuers in the same country. However, I believe that shows as well how the market is seeing this asset class as such in a time with a pandemic. Most of the cover pools are consisted of residential mortgages, and I believe that's something investors really see value in it. I mean, it's something when everything goes wrong, people are still trying to pay their mortgage at the end of the day, and therefore I think you can of course discuss is this justified by risk weighting for investors or for banking treasuries, but on the other hand side is dual recourse basis of a covered bond, especially with this kind of assets behind. I think that's something which is really much appreciated by investors.
Yep. Now, Casper, we haven't heard from you, and we can't let Julian and Matthias take over. So let's hear from you.
I'll try to give a few words to this. So firstly, just on the point of residential real estate backing all covered bonds, in our opinion, is not completely true. Particularly when we look at Germany, we just published a large article in July making the point that there's quite substantial exposure to commercial real estate. Obviously, if you look across Europe and other core nations such as France, that is true, that is residential, and that should support the product in itself. One thing that we haven't discussed is also the general negative supply. So we have actually seen from the core countries fairly good issuance, but the redemptions are really the issue here, I think, and that will actually, in our opinion, continue to support demand for covered bonds if there was any questions going forward.
Well, thank you, Casper. Thank you. I mean, we're all, yeah. I mean, we are of course talking very hypothetically here, and we're sort of second guessing a little bit what the ECB is going to do. But we're talking about reducing the ECB's influence in covered bonds. But I think, to be honest, we're some way off. I think, aren't we? Surely the first step will be to cut back other asset purchases. The second step will be to cut covered bond net purchases to zero, probably, and then as a third step to allow the portfolio to be wound down. Is that, Julian or Matthias, is that how you see the future in that order?
Well, at a certain point, certainly there will be the point of stepping completely back from the market. I mean, I think that was discussed already during the past conferences and during the past years. Was it really necessary to step into this market as such? Because in my opinion, when the ECB started the third purchase program, well, we all believe that this market was a healthy one, and we didn't see any necessity for this. The problem that you have, of course, at the moment, people, well, see it now. They're there in the market, an important player, and I think it should stop at a certain point, but it should be done step by step. So maybe at a certain point, I mean, just reducing it step by step, I think that's the way it should be done, because if you step out from one day to another, I think that will have a big impact on spreads, even though that's maybe from a fundamental point of view not really justified.
Yeah, you say, sorry.
Sorry.
Go on.
Just want to step in and just come back to the figures and the point I mentioned before. We're not talking about stopping the purchase program. We have first to analyze what is or how huge is the net investment of the ECB and the different programs. They're talking about the last months under the APP of nearly 17 billion, most of them, of course, under the public sector purchase program with nearly 14 billion. But the main driver at the moment for the whole fixed income market is the PEP program with nearly 170 billion in net buying last month, and again most of them for focus on public sector assets with 165 billion. So what I want to say is, when we talk about exit strategy and so on, we have to focus first of all before we talk about covered bonds, because that is just a drop on the ocean when you compare it, especially the public sector purchase program, and even with corporates where we have higher net buying at the moment than in covered bonds. We have to talk about this strategy for the other asset classes.
Yeah, but
one point potentially is also to ECB, of course, works as being market neutral. That means that they can't just exit a certain asset class, or if they want to, they kind of have to taper in the same proportions. And what we see is that's even if tapering is probably the first sequence that will happen, I think we have to take one step back and then ask ourselves, was it actually what came last week? Was that actually the first step? Because our economists as leads think that this PEP program could be, of course, it has to be unwound and rolled back, but it could be replaced by further buying in the APP. and then of course you're in the same place as you were before. So I think, as you said before, Toby, this is of course we're second guessing or guessing what's going to happen. But there's a long way, and even if we look at the Fed from the S&P view, there's a long way. So I just wanted to make that point.
Yeah, I'd be interested actually. Matthias and Julian, would you agree that we are a long way though?
Fully agree. I think it will still take some time until we see really ending this program.
Yeah.
And to be fair, we're saying that we expect there's going to be a new normality, even again with the Fed, that the central bank take a much more active role going forward, and we can expect them to stay in the markets for foreseeable future.
Yep. Okay. I think we'll come on to that in a minute. Actually,
yep.
The future behaviour. No, the future behaviour of central banks. But just before we move on to the sort of second way the ECB could reduce its influence. I mean, we've already mentioned the kind of the reinvesting the proceeds. But I mean, that in itself is quite a difficult task for the ECB. And so, given the difficulty of reinvesting the proceeds from maturing covered bonds already held by ECB, could it even cause a reduction in the net holdings of covered bonds?
So I don't see a problem in reinvesting the size we're discussing at the moment. We have maturities of roughly around 30 billion, a little bit more a year. And I think when you look at potential issuance volume from eligible countries from the Eurozone, this is something that the ECB has proven in the past that they were able to reinvest the size. The only problem I see from my perspective that we are more or less, and not only we, but also the ECB is trapped in a witch circle. On the one hand, taking potential issuance volume away with their TLTRO programs. On the other hand, having the necessity to reinvest the maturities. And this year, we're talking maybe about, according to Helaba Covered Bond Research, we're talking about potential issuance volume of 80 billion euros for all euro-denominated benchmarks, not only Eurozone, but worldwide. And when you look at the overall figures, and should we stay on such low issuance volume, what hopefully recovers in the future, hopefully at least for Julien and me, so we need to earn some fees, then we have the possibility to reinvest more or less smooth in the market. But should we stay on that low level, the ECB will get a problem finding enough eligible bonds in the future.
Yeah. Anything to add there, Julian?
Yeah, well, not that much to add. I think Matthias just pointed it out. At the moment, with such low issuance level, it's difficult for the ECB really to get their target sizes done. But yeah, well, hopefully in the near future we will see a bit more of issuance as well, and then it should be possible that they keep at least their investment portfolio on a stable basis. So that's certainly possible. But yeah, as you pointed out, Toby, it will depend as well how TLTRO conditions will develop over the upcoming months and years.
Well, you've preempted my sort of second set of questions there.
Oh, sorry for that.
It's a very good segue for me. So yes, so. Of course, the second way the ECB could reduce its influence is the reduction in the TLTRO, presumably by reducing its economic attractiveness, by increasing the funding cost above that of comparable covered bonds. Yeah, so I mean, I presume it's true to say that the majority of TLTRO funding has been used for carry trade, and once, for example, it goes back up to -50, then presumably the arbitrage goes. So yeah, what do we think the ECB will do first of all with that rate, Matthias or Julien?
So when I can take your question, Toby, looking on the reason why they introduced TLTRO from our perspective, I would say there was a necessity early in that crisis, in the early day of the crisis, to offer bank a cheap source of funding, where we had in March 2020 the possibility that the market was more or less closed, more or less, I would say, because we have seen some issuance, but for sure, the market was closed for at least some weaker issuers and was definitely not open for all products. So at this stage, I would say TLTRO was a great instrument to support the banking sector and overall the whole European economy. Looking at funding conditions at the moment, from my perspective, I don't see any reason why the ECB should keep TLTRO in that place, because when you're only looking from that argument, market access, I would say the market is open for everyone at the moment. When you look at issuance activity, not only in covered, but also in pref and non-pref and even in capital, I would say every issuer has access to the market. It's just a question of price, but even weaker issuers receive a incredible good demand from issuers. So that is no argument anymore to keep TLTRO in place. But saying that, if there are other arguments for keeping TLTRO in place, meaning recapitalize banks after the crisis, that is another argument, but then you have to communicate it, but I haven't heard something like that in this direction.
Okay, so what if you were sitting in the ECB, what would you do with the rates?
This is a question for me. It is pretty unfair to answer this question because I'm not sitting at the ECB. Okay, I sit around 2 kilometers away from the ECB, but on the completely other side and have the different interests. But bring it to the point. At the moment, I would say you can't stop TLTRO from one point to another, but you have to reduce the rates, making it an instrument where issuers have access to liquidity as a lender of last resort. But for a rate that is comparable, or saying that even worse than the comparable rate for similar instruments that you can issue in capital markets like covered bonds, pref, non-pref, making it so unattractive that the normal issuer would go to the market and not taking central bank money. That would be my advice at the moment.
Okay. Julian, what about you?
Well,
before you answer, I'm going to put some numbers there, which basically, I've called up a few people, and people say that it should first of all fall to -75 and then probably fall to -50 middle of next year. Does that sound a reasonable way forward?
Well, I mean, as such, certainly yes. What we shouldn't forget is maybe I'm here a bit from the German perspective, who at least when it comes to the pandemic is acting quite cautiously. Well, what we shouldn't forget is that we are still, even though when you look on the economic growth, it looks quite good for most of the countries in Europe. We are still in the middle, or well, I would say we are still in the middle of a pandemic, and you don't know how this could develop over the next months. Of course, I mean, you have some countries where it looks like, okay, the pandemic is over, everything will return to normal. I can only judge from Germany, people are still acting cautiously, and I wouldn't be surprised if we see any fallbacks in the upcoming months, and therefore I think it's understandable that ECB is still acting on a quite cautious way and leaves every option on the table. I mean, from today's point of view, I would fully agree. Okay, let's reduce the conditions, make them step by step a bit less attractive so that we get back to normal. But as said, I think there are still some unknowns in the future which we still should take into consideration, Stan.
Unknowns or known unknowns?
Well, known unknowns, and you never know if there's maybe an unknown unknown. I mean, we don't have a crystal ball here, and therefore it's in my view, reasonable to keep all options on the table. As said, if the next month proves to be stable and that I was maybe too cautious, then of course that's fine. And I would be happy if that would be the case. But in my view, maybe we'll see some not so light surprises potentially as well here. Definitely on the pandemic side, and maybe as well something which we wouldn't expect in banking books.
Yeah. Casper, do you have any views on the TLTRO as a general concept and whether it should still be at the level it's at right now?
No, I don't have a view of whether it should be in the level, but I can tell you that the level is definitely much higher than it was before the crisis. So we went from around 500 billion to about 2 trillion in terms of TLTRO. So that's not all covered bonds being replaced, obviously. But on the other hand, you can't be arguing for more issuance and more investors coming to the market if you leave this funding there at this attractive rate. So obviously, this is cannibalizing new issuance in covered bonds, and particularly it's wiped out short issuance in the euro market. Again, as rating agency, we rate what is around, but if you are looking for more to rate, obviously a reduction would be preferable.
Sure. So, I mean, I guess we're all agreed that the rate, well, it's not going to come down immediately, and probably the ECB will take its time. Does that therefore mean, Matthias, that covered bond supply might not materially pick up until 2023? Do you think?
Yeah. When you analyze the data, you clearly see a relation between the rate of TLTRO and covered bond issuance activity, and you can also analyze the amount of retained covered bonds that were used as collateral at the ECB. So we can only guess in this perspective. We have maturities of roughly 120 billion next year, and as mentioned by Casper before, for this year, we see a huge negative net supply if the ECB will keep the TLTRO rates where they are, because there is only a minor necessity for banks to go to the market. Saying that, in terms of covered bond issuance activity, with the maximum maturity of the TLTRO, is not directly competing for necessity to refinancing mortgages, especially when we talk about longer dated resi mortgage. A little bit different when we talk about commercial mortgages that are normally have a much shorter maturity. But I think that's a topic that we should analyze a little bit deeper, and maybe Casper can give us some insights from the rating agency's perspective on asset liability mismatches in this regard when you refinance everything with TLTRO.
Well, I mean, there are different views here, of course. There's the view that asset liability mismatches have improved because everything that's been issued has been very long and it fits the assets, longer assets better. But obviously, you would want to have as good a match as possible, and potentially on the public sector side, it's been difficult to find the right maturities for issuing. I think more it's interesting if we take a step back again and look at who's gone to the market, who's active in the market, and it's maybe also coming back a bit to a point we haven't touched so much upon, but deposits, which is also, of course, a source of short-term funding. So we've seen quite a few of the participants coming to the market being issues without the deposit surplus of others. And for example, I could take an example from my backyard or Sweden, where basically a lot of covered bond issuance, even in SEK, has been removed due to huge inflows of deposits. So that's another thing. So when you look at the LMM, you really have to look at almost the bank's LMM to understand what's driving the full issuance picture.
Thank you. Julian, can I just turn my original question to you? And it was, if we think that the TLTRO is going to be remaining at its level or perhaps gradually reduce in the next 12 months, surely that means that we're not going to see an increase in material increase in supply until 2023. Is that something that you somewhat regretfully agree with?
Sure. I mean, as you just pointed out, of course, regretfully. However, I mean, the point that Caspar raised is important as well. I mean, it's not only the TLTRO money which plays a role here. It's as well how the deposit base will develop. If we see bigger confidence within the population, and people are likely to spend more over the next months, I mean, that could mean as well that we see an increase in covered bond. Same on the lending side. If we see more lending, this will have as well a positive effect. So, of course, all other things equal, if the TLTRO rate will remain or slightly lower at the moment, this will have a negative impact on the covered funding. But I think there are the two other points that we should take into consideration as well. And if this develops in favor of covered bonds, then yeah, maybe we'll see a bit more issuance, but all other things equal, would agree with Matthias' view here. It won't be a huge issuance year in 2022, but yeah, as said, no one of us has the crystal ball, so a lot of factors who could come into play there.
Yeah, I mean, there will be, of course, issuance, and some of it might surprise us. Which issuers do you think will be incentivized to issue covered bonds again first, and in what maturities? Back to you, Julian, if you don't mind.
Okay, yeah, sure. I mean, of course, why is the covered bond market so attractive? You get relative cheap funding for long-term issuance at the end of the day. I mean, Matthias pointed it out earlier. When you look on different tenors, I mean, the pickup is rather low. So it makes sense, of course, for issuers who have the need for long-term funding, because the TLTRO money is limited in terms of tenor, of course. And then even though most of the spreads across jurisdictions are, of course, compressed to a certain point of view, I think especially for the core jurisdictions, it's what we see as well this year, that even though it's below maybe redemptions that are coming up, that France and Germany are relatively active again. So we see core issuers certainly incentivized. And especially then for when it comes to countries who are not part of TLTRO money, and when you have as well the assumption that, for example, the cross-currency swaps are attractive for, let's say, Norway, Sweden. I mean, even though Sweden have, of course, a big domestic buyer base, Canada. I mean, that are certainly potential candidates which could come then again to the market. So I think it's a very broad scope there who could be incentivized, and therefore that's something we could see then going forward, of course.
Thank you. We actually, Caspar, go on. We also have a question for the audience.
Just a quick point on that, because I think also we might see, just because of the communication that has come, issues being uncertain about exactly direction, maybe as much as we are, and being afraid of missing the opportunity, right? So if we certainly see stronger wording, or certainly the Fed has been more detailed on what they intend to do, you could see a certain number of issues coming back to the market to avoid losing the opportunity, because the funding conditions now are unprecedented, and you don't want to miss out if you want. And I could see we could see sort of a US dollar issuance. Of course, that's less in the euro area. Pick up at the end of the year if the Feds make true of their plans.
Well, yeah. In fact, we've seen a very busy September in Europe, also just for general FIG issuance, which I think part of the motivating factors is what you say. The time has been called on these exceptional conditions, funding conditions. We do
one last food for thought when we talk about maturities. It is not only the question where banks want to issue, but it's also the question what kind of maturities investors want to buy. And what we have observed, especially after the summer break until last week, was that everything beyond 10 years was difficult to issue, saying that nearly 50% of this year issuance was in the 7 to 10 year bucket because of the demand from bank treasuries, especially there. And after a slightly increase in yields the last 2 weeks, we have also seen 2 bonds from Dutch issuers in the 20-year bucket with overwhelming demand, saying it seems to be that the window is open at the moment for longer dated issuers, but this window was closed just some weeks ago, as there was no investor demand for this tenor, which also has to do something with the tapering discussion in the EU. So predominantly, I would say when we talk about maturities, everything's possible until 10, and sometimes the window is open as is open now for longer dated issues.
While we're still talking about TLTRO in the whole, we do have a question from the audience, I'm pleased to say, which is, do you envisage further TLTRO tenders after December 2021? What about the Premier? Good question. Julia, what about you?
Wow.
Question.
Well, it's a tough question. Well, I wouldn't rule out that there are further TLTRO tenders afterwards. What about the Premier? Really difficult to answer this question. I mean, I could say now a number, and that would be just put from somewhere. So difficult to say. Yeah, but I believe yes, there could be further TLTRO tenders afterwards, depending on the economic development. But really to put a number on it in terms of Premier, difficult to say. So.
Yeah.
Okay.
Assuming that we don't get other virus variants that are even more difficult to handle than Delta, maybe Rho, Sigma, or whatever you want, and hoping that the vaccine is also supporting us against these variants. I would also assume that we get further TLTROs next year, but the Premier would be less attractive for banks that we have at the moment. But it would definitely be negative from what we know at the moment. So maybe first one -50 and reducing is to -25 somewhere in 22. So to set a number.
We won't hold you to those numbers, Matthias. Don't worry. No more will come up to in a year's time.
I will call you Matthias on these numbers.
Of course. I would assume that.
Okay. Thank you. Casper, anything to add there? No. You're on mute, actually, Casper. Sorry.
I am, sorry. I agree, or economists agree, that there's highly likely to be another round of TLTRO. So the levels, I'll leave Matthias to say.
Okay. You're doing a very good job of trying to avoid talking numbers. But yeah, okay, thank you. So I mentioned that at the beginning that there are 3 ways the ECB could reduce its influence. We've gone through 2, but the third way the ECB could reduce its influence is a more data-dependent unwind of QE, a taper of the total quantity of bonds purchased across all programs. I know we touched on this a little bit earlier, but do we think, panel, will this be a response to the fiscal stimulus that we are seeing in most countries, or will it be dependent on real growth? Maybe Casper, start with you.
We think it's all down to inflation. So if inflation returns, you could expect some kind of tapering. And basically, what we published, or economists published in the US, basically the way out. So if you want to read about what we believe happens when there's more clarity, go ahead and read that. But there, the sequencing is exactly tapering, then lift off, and then right sizing the balance sheet afterwards in those 3 steps.
Julia?
Yeah. Fully agree. I think it will depend on inflation, and they're really on the real growth. Madame Lagarde just pointed out that the current inflation that she sees at the moment, she considers this only to be temporary, as high as it is right now, and therefore, fully agree with the view of Caspar, of course.
Matthias?
Bring it to the point. Hopefully, it is only inflation.
Yeah. Okay. Thank you. Good point. I suppose related to this is: do we think green spending as part of the new Green Deal will have an impact on growth and inflation? Caspar?
Our economists believe it can have, of course. There's significant investments that needs to be made, and that could, of course, lead to that necessary spark to lead to inflation. When we look at the green part of, if we take a step into covered bonds and look at green covered bonds, actually we've seen quite a bit of issuance compared to last year in green covered bonds. And the ECB, we know, are discussing or debating whether to make the purchasing program a tool in this area to get more green issuance in all asset classes, including covered bonds.
Yeah. Caspar, you mentioned earlier about the ECB and its powers. Do you think that the powers that the ECB has given itself are now a permanent feature of the financial landscape when we look at future crises? The genie is out of the bottle, but will sort of current measures be appropriate for future crises? The precedent has been created.
Well, I think we can all agree that this has been trial and error. A lot of the crisis, basically since the financial crisis. So we've gone from one level to another. So there'll definitely be learnings, we're sure, from this, and there'll be a different kind of action coming next time. However, as the article says, or Fed article, the balance sheet of a central bank will not look like your grandfather's central bank balance sheet. It will be a different one going forward. So we believe ECB is also there to stay and play an active role going forward.
Yeah.
Of course, there's lower levels. That's clear. But
at the moment, yeah. What do you think, Julian or Matthias, about that? Do you think that the rescue and support measures as of now, will they be the automatic future support and rescue measures of the future, whether they're appropriate or not?
Yeah, well, as Caspar pointed it quite out, it was a kind of trial and error. And I would assume the things that work during this crisis, of course, that will be applied as well during the next one. If they will work the same way, it has to be seen. Because at the end of the day, as well, you have a kind of anticipation of market participants that what happened in the past will be applied as well in the future, and so it's taken as a kind of normal way to act. And it has to be seen if that will be sufficient for future crises, however they will look like. But I'm pretty sure that the tools that work this time will be tried to apply it as well when the next crisis will hit us.
Matthias.
One thought on that. When you look at the tool that the ECB has used during this, at the end, deep crisis, as it was a very deep crisis, especially in 2020, the deepest that we have had, at least in Central Europe, since World War II. From the short-term perspective, these measurements were very successful, stabilized the economy. We can discuss if it's only the ECB, but I would say together with the response to the crisis from not only the EU, but also from the single jurisdictions. From the short-term perspective, successful. From the long-term perspective, we just don't know it, and we have to see what the future will tell us. if the response was maybe too huge to that crisis or not, and then we can answer the question, what should the ECB or should central banks in general do during the next crisis?
I mean, you can imagine though, the next economic downturn, you can imagine people clamoring for mortgage moratoria, for example, and maybe the economic downturn will be for different reasons next time, and therefore it's going to be very hard for a government not to enact those again. That's part of the problem, isn't it? That current measures aren't necessarily appropriate for future crises.
Yeah, and if you look at it from a social perspective, I think there's probably a discussion to be had there as well. Who's benefited from very low interest rate and who's not going forward?
Yeah. We actually have a question from the audience regarding the ECB, and it is: do you think that the ECB's exposure to so many banks in the covered bonds it holds, could compromise its independence as a bank regulator? I'm gonna put this one first to Casper, actually.
Well, it's not something. It's probably going to be my own opinion then. I think we accept the ECB as the lender of last resort within the euro area and act as such. I mean, they have to do what they do. Whether they should then be also looking after some of these banks in more detail and maybe even deciding what the banks need to do, that's a different question. I think it's also an ongoing story, the capital union. So we might see the roles, or at least adjust over time.
Yeah.
So,
Julian, sorry, was that Matthias? Sorry.
So overall, there should, and I think there are, very high, very big, and very large Chinese walls within the two different tasks of the ECB. On the one hand, being the lender of last resort, and on the other hand, supervising at least the largest banks in the Eurozone. So I really trust completely the ECB that they fulfill both roles completely independently. Saying that, I really fear that should there be a case in the future that politics could put pressure on ECB as they have both roles. So I would really fear that there will be pressure from outside, not so much doubting the role of the ECB here.
Okay, and Julian, just to finish us off with this particular question.
Yeah, sure. I mean, officially, I think there's no doubt that you have these Chinese walls and independency within the EU, within their respective mandate and their function. However, of course, there is the risk as well in the future that you will have some influence from the political side there. How long the ECB will really be able then to remain their independence? I mean, fingers crossed. I think we all hope that this will remain the case, but depending on how hard the crisis, the next one could hit us. Well, let's see how much power or how much pressure the politicians from the various countries within the European Union will try to put on the central bank then.
Yeah. Okay. Well, believe it or not, we run out of time. So I'd like to thank you very much, Julian, Casper, and Matthias, for being great panelists. Thank you so much. We've even had questions from the audience, which is a very good sign. So thank you very much indeed, and thank you to the audience for listening and posing questions too. That's great. A couple of things I need to draw your attention to. One, and I haven't mentioned this so far, which is perhaps remiss of me, but we have the Global Capital Covered Bond Awards this afternoon at 14:10 British Summer Time. Do tune in for that. But up next, we have a live keynote address, an interview with Eduard Fernandez Bolo, member of the Supervisory Board at the European Central Bank. So do tune in for that. but also please join me in thanking my panelists. Thank you very much.
Thanks a lot.
Thanks, Toby.